High volatility in the markets means high implied volatility in options. What do you do when IV heads toward the ceiling? The Risk Wranglers will break it down and more after the bell. The Risk Wranglers. I mean, I'm just laughing my ass off over here.
That's the intro now. That's us.
The Risk Wranglers. It's so fun. I'm just dying to be a cowboy. I don't know. I can't figure it out. Okay. How are you guys?
What's up with my? There we go.
You're good.
I'm doing all right. How are you, Lex?
I'm good. I'm good. Timely, the high volatility. I mean, every time I look at, I always go to CNBC in the mornings because it just shows you the pre-market right away. I just want to see what the Dow Jones is doing, even though I don't care about the Dow Jones. The NASDAQ and the S&P 500. Those are my three that I look at, and they're right in order, right? And every day it's either a big red number or a big green number. In order to be high volatility in a green number, it has to be a bigger green number, right, Mark?
Yeah, I don't think anyone complains about high vol to the upside.
No. Yeah, I want the market to go up thousands of points every day, essentially, I think, for the most part. But no,
hold on. Wouldn't because of option skew, wouldn't that be the opposite? Because they're implying, since calls are lower priced typically, like in the same percent distance as puts.
Yeah, I think that's fair. I think we're talking more about the emotion and sentiment of an up move a little bit in terms of scariness. And if
an up move happens of 100 points, nobody with 401ks.
No, that's the point. That's the point. Okay, so we're going to talk about this high implied volatility environment. So, the opening we talk about high volatile markets, NASDAQ, S&P, and anything else you can throw in there, Tesla, Apple, you name it, means what? Well, option pricing is going to get higher, right? Because these moves are big, and market makers and the people who make these markets are not going to sit there and sell you cheap priced options when these markets are moving so much. So naturally, one implied volatility moving up takes the whole board up, right? And then we can talk about skew as well along the way. Now, do you guys have are you noticing anything relative to what you guys are doing? I know, Mark, you do a lot of RIA kind of stuff. I know the retail community has a big short iron condor sort of bias. They love that stuff, especially with zero DTEs. And I know I was talking to my brother the other day, and he's like, God, this is insane. I'm doing things 75 points either way of at the money and getting hit on them. I'm like, yeah, right. Welcome to the world of craziness. What are you guys seeing?
I think there are two big temptations that retail or buy-siders in general have when the market's doing something like this. The 101 inclination is to go rush and buy puts. That, oh my God, the market's crashing. I need to buy puts. Puts are protection. And so that drives up the price of puts, and puts are getting more expensive because there's higher vol. And so, that's the first temptation. And then the second temptation, like you said, is people say, oh, there's high vol. Well, that means I should sell it. And so, now's a great time to, lay into short vol or, but the reality is if you're putting it on through a condor or something like that, you're getting bumped out in this market. You're selling $1 for 70 cents and losing 30 cents.
Yeah. Yeah, and you think, I mean, it looks like a great trade too. I'm selling a $1 iron condor for 70 cents. I mean, sign me up, right? And you keep getting knocked out. That's insane.
Yep. Yeah, a lot of chop, and chop is 25 vol is a lot different than 15 vol.
Oh yeah, for sure. Jason, what are you seeing? Anything similar? What's going on in Volland? Where are we seeing some?
So in Volland, I mean, we're seeing a lot of people buy puts. Pretty much as soon as like 5,800 was broken, the puts started getting bought in volume, in bulk. Right. And that's kind of, we started seeing an assisted drop because of that. Dealers get long deltas and they have to sell, right?
Yep.
So we got like an assisted drop all the way down to 5,600. We do a lot of like statistical analysis, and one of the things that we pay a lot of attention to is spot vol correlation. So, the movements of VIX compared to the percent movement in SPX.
Right.
And when that gets out of whack, you can, that's when you start to see panic and or illiquidity for dealers in the market. We did start seeing a liquidity drop as those puts were getting bought. I guess, the dealers don't want to be too one-sided in a volatile market, right? So they're demanding more edge. And, the puts being bought also. So that expands VIX twofold, right? And two different reasons. And it wasn't until Monday of this week, though, that we saw like a vol, what we consider, or what I consider a vol event, which is VIX moving 2 points more than the spot vol correlation implies, right? The normal spot vol correlation. And, all prior to that, we were getting sell-offs, but VIX wasn't reacting as strongly. And that's because when we were at all-time highs, we were in the midst of a lot of in-the-money customer short calls. They sell their calls to buy their puts, and then it hedges their portfolio.
Sure.
We were in the middle of those sold calls at that time. So nobody was panicking when we were dropping from all-time highs until Monday, when I think something, I guess, unexpected happened, and we got that 2-point move. But based on a historical study we've done since 2013, this has happened 17 times where VIX has moved 2 points more than spot vol correlation implies. 17 out of 18, we've recovered that within 3 weeks from the prior day's close. So,
okay, what does that mean though? You recovered it. Does that mean that the market recovered?
Yes.
Okay, I just want to make sure that's clear.
The market reaches the prior day's close to the vol event day within 3 weeks. So, like, you see, like, in what do we have Monday, like minus 2.7% or something like that.
Yep.
That should recover by the end of the month.
Okay, and you're starting to see that setup occur.
Yes.
Okay. Yeah, I mean, Gal, I got to tell, I'm watching the market as we speak, and it's rallied tremendously as I'm sitting here. Because, you know why? Because we're talking. Yeah.
Well, probably what's happened if because I was looking a little bit before we came on.
Yeah.
For the past 3 days since that Monday, VIX we've gone the opposite direction. VIX has undershot spot vol correlation. I think 2 days ago we had minus spot and minus VIX, right?
Yep.
Yesterday we had minus VIX a lot and spot only going up a little bit.
Sure.
It kind of, when we see that expanding VIX, it, rushes, it's a rush. It's happening concurrently. When we see the squeezing VIX a little bit, it's almost kind of, I relate it to like a cartoon guy running. They run in place for like, 3 seconds and then they go, right?
Yeah.
That's kind of like how the short vol works. So, I think right now we're in that running in place mode where VIX is coming down. Yesterday was only a 0.5% move, only a 0.5% move.
Sure.
And VIX is implying like 2% move a day. So, so historical volatility is beginning to at least calm down, beginning to. Yeah. And, implied volatility will follow. And with that, comes a rally usually.
Yeah. Okay.
That's what we're seeing.
Yeah. Yeah. So what kind of things can the retail person do? And listen, I will totally accept the answer. Sit on your hands and let it play out. I mean,
that's going to be my answer. I mean, the reason I'm wearing this beat up old hoodie is because I'm not watching the markets. I'm going to work in my yard. If you want to hit the sell button in this market, go dig a ditch and then decide if you still want to sell after doing that.
Yeah, I agree with that.
Go dig a ditch and bury yourself.
Well, look, if you're, but Mark, I think to some degree, Mark, to a lot of degree, Mark's right. I mean, if you're a premium seller, typically, and what I mean by that is, you're the short iron condor person, and you're looking for a market to kind of be within a nice little range, and you collect your premium and you kind of rinse and repeat. Okay, that's fine. That typically works. In this environment, you don't know what you get. To the upside and the downside, even though we like upside moves, if you breach a short to the upside, you have the same problem you do to the downside. It just happens differently. So those people, and I talk to them a lot. I talked to someone the other day who's just bitching and moaning about, I'm losing so much money with my short iron condors because I keep getting breached. I'm like, you know what you should do? Close it up, take a deep breath, and go do something else for now and come back and let this settle in. Right.
Regime changes are difficult. Jason
Yeah.
sort of pointed to it on the, with the reactivity of vol and spot vol correlation, that both with the move up in vol and with the resulting move down in vol that will eventually happen, it's a little sticky in terms of, getting out of that regime. And, it's sticky going from low vol to high vol because we didn't react 2 months ago when the market sold off a little bit. So why do you react to the first 100 or 200 points down? So vol's always going to be a little sticky because the bias is generally towards the south side with implied volatility. So, it is going to be a little bit like that cartoon character getting running for, good reasons. Sure. But when it moves, and you got to be aware of that. And no mas, no more iron condors, no more short puts, and resist the urge to be on the buy side too.
The typical premium seller is getting destroyed here, not just because of the strong movement, but especially when implied volatility is expanding, you don't even have an exit plan because iron condors are short vol trades. So when implied volatility is blowing out and you're getting breached, you're pulling off at pennies on what you on the dollar. So you may have like a little bit of advantage like right now, but again, at some point in time, that cartoon character is going to run and you're going to get breached on the upside. You're not going to be very confident in your condors right now, even if they succeed once or twice.
Right. No, I agree with that. So what about this idea? High implied volatility, you want to take advantage of selling something. I get it. What about broken wing butterflies up and down? I mean, if you're wonderful at picking direction, you pick a direction. But what if you did them both? Now, on major moves, these things tend to be cheaper because of the high implied volatility. And you want a big move. You want it to blow through strikes, assuming you do it, you structure it correctly. And we could draw that out. So if you make the second part of the broken wing butterfly a tighter dollar spread, that means you want it to run through because you have, your long debit spread is bigger than your short credit spread. So you absolutely want it to bust through. What about that kind of a strategy? Does that make any sense at all?
I think if you want to sell something, you should be selling time spreads. I think you should be taking advantage of the fact that 2-3 months out, VIX futures are 22, 21, something like that. I don't know exactly. And sell something further out in the curve where vol is going to have a lot more time to realize and come back down to its mean. And take your time spread leg and be long gamma for this chop in the interim. So if you really need to see red and smash red, time spread.
Yeah, you like that? And you could time spread can be a diagonal too. It doesn't have to be the same strike necessarily, right?
Get short vega, long gamma.
Okay, get short vega, long gamma. So that means for some of the beginners, right, we're buying in the time spread where we're buying nearer term stuff, selling longer term stuff. Now, the absolute implied volatility in this scenario,
you said short time spread though, right?
Yeah. So he's buying front month closer stuff and selling farther stuff. Is that what you mean, Mark?
Are you allowed to do that in most retail platforms?
That's a good question. I'm trying to think what we do at Tradier. There are in indices. Probably not, because you get cash settled. So you're left with a naked short. In equities where you get a stock, obviously you have the money to margin that you do. But I think if it's expiring, you got a problem, you got to get out of it. If it's second month, you got time. I like the strategy. Now just so people understand, you're probably buying a higher implied volatility absolutely than what you're selling, right? In selling that time spread. So you're probably, if you're buying a 50, you're probably selling a 45 or 40 even. So just make sure that you're not selling the average of those two. You're selling some other number that we talked about several shows ago. What the math is there, but you're still purchasing a little bit higher volatility to get that gamma and sell that vega. But the whole curve, the whole implied volatility scale is moved up in your underline, so you're selling vega at a higher level.
Right now, that's kind of tough. I don't know if I'd agree with that right now, especially because right now we're backwardized pretty strongly, aren't we? Like March is a lot higher implied vol, and April's a lot higher implied vol than May and June, right?
So I have the VIX futures curve in front of me from like 2 days ago. March is 25, May is like 22.
Yeah.
Then it's pretty flat from there on out.
Yeah.
Yeah.
So I don't know. I mean, I do like the time spread, buying a time spread, but way further out because you do get that expanding vol. But I don't know. Usually, I don't usually like to do that. The broken wing butterfly. If you have two of them on, it's almost kind of like when you have a strangle or something, like something similar to that.
Yep.
And I'm assuming that you're pointing your broken wing out of the money, right? You're not pointing it toward price.
Yeah, I mean, if I were doing them now,
like Batman.
Yeah, if I were doing them now in any, I would. Tesla's gotten just the ever loving hell beaten out of it. I would be doing an upside broken wing butterfly, and I'd probably, I have to look at the board, but I would do maybe a 15 strike long to short, and then a $5 to $10 strike my short to long.
Yeah, so it's pointing away from price.
Yeah, pointing away from prices. I think that could blow through, and I'd probably do it 30 days in, and I wouldn't do it 10 days in. Yeah. So somewhere between 11 days to 30, I'd try to structure that. I think I get it at a pretty good price too.
If you're doing that though, dual-sided, that could get pretty expensive. I mean, you might as well just buy the strangle, right?
Well, I don't know if it's that expensive. I mean, the strangle's got to be way more.
It's only more by the amount of premium you're collecting on the far out wings that are short. Yeah. So it's not like that much.
Yeah, I don't want to buy. I don't want. Yeah, I may be Vega neutral on my butterfly. I'm super Vega long, and gamma and theta long on my strangle for sure at really really high volatility. But like everything else, we have this debate all the time, and we used to do this in the pro trading world. Is when implied volatility is high, it's high for a reason, right? And it's like musical chairs. If you own it, you probably can scalp your gamma in these markets, but one day the music's going to stop, and you better not be the one who doesn't get your ass in a chair when the music stops. Otherwise you're done. You're out of the game. So
I like that time spread because you got a little tailwind for you.
You got a little tail for it. Yeah, and I found out from someone texted me that you can sell a time spread to Tradier. You need the naked short. You got to meet the naked short requirement to do that. So
it's a cash secured put or
or if it's on the call side, you got to be just meet the naked short requirement.
So
I think the naked short requirement for a call actually.
I don't know. Maybe I'll get that in a second. I forget what it is. I think you have to have a certain amount of money and a certain option level certification.
In theory, that risk is infinite, right?
Yeah. Well, yes. The
broker is short a put on you if it gives you any short call requirements.
Right. Yeah.
Yeah. But you can do it. I mean, I'm sure you can do it.
Portfolio marketing.
Going back to the broken wing butterfly, dual-sided, and this goes for strangles and straddles too, which is why I don't like to trade them. You're going to lose on one wing. Well,
that's like a double.
You're going to lose on one ring, so you have to pay for that wing.
Yeah,
with the profits on the other. And in order to do that on a dual broken wing butterfly like that, it needs to almost take its time a little bit so that you can, get more gamma when you actually realize a move.
Yep. Yeah, no, I understand.
It can't take too much time because then you're in the pit, you're in the valley of death in between them. So, I mean, personally, like if you don't have any kind of edge, you're not going to get it from high volatility. Like if you're option trading and you don't have that edge, you're not going to gain it just because there's a different regime. So I think that sitting on your hands is
you're liking the sitting on your hands, aren't you?
Yeah. Well, the only thing that I would do if you're doing something dual-sided is on the upside, I like short Vega moves because eventually that implied volatility's got to come down at some point. But if it doesn't, on the downside, I like time spreads more because that's a Vega positive move. So the implied volatility gains from the move that you're hoping to realize is taken advantage of by those two trades, one side or the other, or just long gamma verticals. So that's the other thing too, is that skew is usually elevated at this point in time. So if you do verticals as opposed to anything even fancy, like long gamma verticals, especially on the downside, they will be cheap because skew is usually elevated. So that further out of the money option has a much higher relative implied volatility. Just don't put a lot of money into it either. So so it's low risk, skew helps you out quite a bit on that trade.
Yep.
And you know, and it's also very low maintenance, so you don't have to sit there and babysit it and sell this wing and, you know, sell at the right exact moment. So personally, in these environments, a delta butterfly that's higher than the market, and short gamma verticals, long gamma verticals. Short gamma verticals, you're gonna die. Short gamma verticals below the market, and you know, that will probably be the most cost efficient way to play something like high vol. And if you don't know what we're talking about, go sit on your hands.
Hold on, I'm building something. Green. You're probably wondering why I'm looking up so much. I have all these screens. I have all these screens in front of me, and I have Tradier Pro up top, and I'm gonna share my screen in a second because I built one of these broken wings just for fun.
Oh, okay.
Let's do it. You guys good with that?
Yep.
All right. So, Luis, if we can bring that baby in. Okay, here we are. So here's the way the broken wing works. And again, little bit of a teaching moment just for some of the beginners. I know if you're advanced, you get this already. And I picked these randomly. So this is Tesla. I'm a big fan of Tesla, the stock. I love trading. It's super busy, super active. Prices are big. I love big prices. I like fat, juicy premiums. Here is a chart, a year-long chart of Tesla. Okay.
Next time you say big, juicy premiums, I want you to say it in a Trump voice. The premiums are huge. Nobody's ever seen it like this before.
So here's where Tesla was, way down here in the $1.75 range, $1.66, right? Yada yada yada. But we got way up here to 468. Here we are now after this whole situation. So if you're a little bullish in Tesla, you got, you know, pretty long path to go. And I'm saying I'm bullish. I'm not going to tell you my reasons why I'm bullish, but I am. Okay. Now, that is a trade thesis that you have to decide as a user. You can't follow me because personally I'm not very good at direction. But if I'm a betting man, I've put on this broken wing butterfly. So here's how it's structured. 255 call, I'm long, and I'm playing to the upside. I've got 15 points on my long call spread. Okay, and then I got to add the short call spread to it, and it's only 10 points. 15, 10, I can make 5 total, less what I pay for this. So midpoint's 230. I can make 5. I can make 270, right? So is that expensive? Not really. Okay, and look, you can play with this. You can say, I don't want to spend that much. Let's move it down to 10 and 5, and all of a sudden it goes down to $1.92. I like the 230 kind of level too, right? Because if I hit the middle point on this guy, right? I love hitting the middle point because now that spread is worth a lot. That's a home run. So the best point is that middle point right here. That's my max profit, is way up there. Make sense? Anybody want to comment so far?
No.
And look at what happens on the risk graph. You got if this goes to infinity, you make a finite amount. You make that difference that we just discussed, okay, on this thing. And then all you can lose is what you pay for it down here, and that's all risk defined. Again, this is a 10 lot, folks, so don't make sure you understand.
So what you just said is true, and that's cheap if you go up. Now, if you're doing a double, you're going to 35, and I know it's going to be more than 235 on the put side, but if you do a double, then if you exceed that 270 to 280 area, you're only breaking even.
Right. That's correct.
That's why I don't.
Yeah. So I think it's a great point. So what Jason's saying is I'm gonna save this spread, right? I'm gonna erase this, and let's go. I'm just gonna pick randomly to the downside. So let's go 215, and we're gonna go down to 200 twice, and then we're gonna go to 190. So to the downside, it's $2.15. So as Jason just said, I was paying 230 for the upside. I'm paying 215 to the downside. I'm netting myself out if I do double of these, right? Mm-hmm. The only way I win is if I hit the home run ball and hit the short strike on one side. Yeah. That I'm not advocating for. This spread, I'm not advocating for double broken wings. I'm advocating if you have a directional bias, there's a great reason to do a broken wing butterfly.
I definitely agree with that. I think that if you have a directional butterfly, one broken wing butterfly is good. it's a solid trade.
Yep.
And even if it just kind of crawls to your target, you're making more money if it's only crawling to your target.
That's
So
right.
I like that. What I thought you were saying before was doing 2 broken wing butterflies on one on each side.
Yeah, no. So
and I didn't like that.
Yeah, gotcha.
I don't do those.
So let me do this one now. The 250. Mark, you want to do a diagonal one? So notice here on this one again. Let me send it over to the tower here. So on this one, what I did was this is a diagonal time spread where we're buying the front month and selling the back month. So you can see the dynamics of this. It kind of looks like a back spread, right? And a back spread means that you've got curvature, okay, and gamma. So you do okay to both sides. It's a credit spread, right? So if stock goes to 0, you're going to make that credit, right? And you can make a finite amount, to infinity on either side, right? Because you got the difference between the strikes plus your credit. Make sense? So Mark, you like these, right? Any comments you want to make on this one?
I don't actually tend to execute like diagonals like this.
Yep.
I would more think, but like the Greeks of this position, I would say are more what I like, having that short back month Vega and long some gamma from the front month.
Yeah, let's take a look at this real quick. Go ahead, keep talking. Sorry.
I mean, whether like this simple example could be like short, like a strangle swap or something like that, or a straddle swap, or
yep.
Like you could also put it on with futures and
sure.
short long 0 DT straddles. Like you'd be crushing it if you bought an SPX straddle every day these days, even with this vol.
Yeah. So and look. So he's got big movement positive, green positives here. Here's the Greek profile. Okay, deltas are pretty flat. Gamma, you're positive, as Mark said. So you got 2.85 positive gamma. Theta, you're paying for. That makes sense, right? We're buying front month stuff versus selling back month stuff. So you got some theta you got to pay for. Your Vega is exactly what Mark said. It's a short number. It's a pretty good short number for this. This is only this is a 10 lot. So this isn't bad. Okay, and we're not going to talk about row today, but so that's what you got for Vega, right? Now, if you wanted to do this on the same line, I'm going to make this 250 now. Okay. Let's see what happens. Okay. Similar kind of pattern here. The pricing just changes a little bit, right? So you get a better credit now. That's what happens. And so it just shifts this a little bit. Okay. So this is kind of a fun spread. You're not Mark's trying to take advantage of the short Vega because implied volatility is really high. Right? Safe to say, right, Mark?
Yeah, I don't have Tesla's numbers right at the top of my head, but I have to imagine, given that it's dropped 50%, that IVs are a little rich.
Yeah, for sure. So I'm going to remember this order, and it's in my little remember column here. So I'm going to look at both of these. I'm going to save these guys. So in Tradier Pro, you can remember this stuff, which is kind of fun. So tomorrow I can come back, or I can, even if I don't put these on, I can kind of manage them down the road. So kind of neat. I like doing that. Anyhow, okay, that's enough of the screen share, I think. Any last parting words before we go? This too shall pass. Remember, so I've lived through the 87 crash, 1992. Tell me when you guys were born. 1992. You're not born yet? Okay, cool. And I've lived through the 2008 flash crash, which was the scariest. COVID. I've hit them all. Guess what? Volatility goes back to normal at some point. It goes back. Trust me. No, we never thought we were going back after 2008. It went back to 12 or 7 or whatever the hell it was.
Single digits in
single digits. So this too shall pass, as they say. But I think the important point is, if you're going to trade in this environment, learn how to do it, right? And if you're a premium seller and that's all you do, I'm not going to bash you for that. But this is a tough environment, and you better have exit strategies if you're going to still do it, or go garden, as Mark said, and take a pass, take a break. Any thoughts? Yeah, Mark's doing that. I always trade.
That is financial advice. Go work and go dig a ditch. That's my financial advice.
And
not for yourself.
And our hot levels, Jason, on vol are what again? Just before we leave, 5,500 is a big level.
Right now for at like 5,700 and is like a big level in the near term. our studies have shown that we will hit 57.70 before the end of March.
Oh, okay. That's
17 out of 18 times that's happened.
Okay, good deal. All right, good. So, and you're seeing a lot of put buying. So we got a lot of
support,
negative gamma to the downside for the dealers.
Yeah, but also positive Vanna. So when
I was going to say, what does that mean? What does that mean to Vanna? So I was going to ask you that.
Positive Vanna. So when implied volatility comes down, dealers are going to release their short hedges quite a bit. So
yeah, so they're getting shorter.
They're getting shorter on the way down, but they're getting
I'm sorry. If vol comes down, that higher that higher delta is going to come down, and they're not going to have as much of a long hedge against their short stock.
Exactly, they're not going to have as much short hedge.
So they have to buy in their short hedge.
Yeah.
Okay. That's long Vanna or short Vanna?
Long.
I always get those confused.
Long Vanna is negative spot vol correlation.
Okay.
That's where that comes from.
Got it. All right. Mark, any last parting words before we hit the road?
Happy trading and stay safe out there.
Yeah, I know. It's dangerous. It's like whipping around on curves without seatbelts on, man. All right, guys. Have a good one. I'll talk to you guys next time on the Risk Wrangler Show. Bam.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.